Should you subscribe to Adani Wilmar's IPO? The IPO of Adani Wilmar comes at a time when the market seems past its purple patch and is showing signs of nervousness. At a market capitalization of about 29,000 Indian rupees crore, this mid-cap stock is valued at around 40 to 42 times the annualized earnings for the half-year ended September 2021 on the post-issue equity. This valuation is only at a slight discount to Marico, its closest peer, which trades at 46.7 times its estimated FY22 earnings. But while Marico has made its mark in value-added oils, food and personal care segments, Adani Wilmar is yet to. Adani Wilmar is in the low-margin edible oil and industry essentials business. Its more recent foods and FMCG business is margin neutral as of now. Its revenues grew by 13.5% CAGR from FY19 minus 21 to 37,090 Indian rupees crore, and profits at 39% to 728 Indian rupees crore. Profits in FY21 got a leg up from shifting to lower corporate tax rate of 25.1%. The entire offer for 3,600 Indian rupees crore is a fresh issue aimed at repaying a portion of long-term debt, capex spends, and setting aside sums for acquisitions. While edible oil can provide a steady-state business for Adani Wilmar given its strengths in raw material sourcing and pricing power, what will bring the next level of growth is expansion in the FMCG business. But this is a long-term story. Given that the current valuation appears to capture the positives of the existing business, investors can wait and watch for better entry points in the secondary market. Adani Wilmar's business seems attractive in the light of the fact that the company is present in segments which constitute two-thirds of the kitchen spends of Indian consumers. The staple or the essential nature of the products means that the demand can be quite consistent. The low penetration of branded products in the categories the company is present in, and the expected shift from unbranded to branded products among Indian consumers, is also a growth lever. Adani Wilmar, known for its Fortune brand, has 18.3% market share in the branded edible oils segment in India and is the leader. That said, edible oils is essentially a commodity business with low margins. Raw material costs as a percentage of sales range from 85 to 90%. Much depends on reliable supply of raw materials across all seasons, cost control, as well as the ability to pass on cost increases to consumers. India imports 60 to 70% of the domestic edible oil requirements, and strong relationships with suppliers is key for success. As of March 2021, Adani Wilmar was the largest importer of crude edible oil. The company sources raw materials predominantly from global suppliers, such as Cargill International SA, Louis Dreyfus Company Swiss S.A., AAA Oils Fats Pte. Limited, COFCO International Limited and Vitra BV. As per the offer document, Wilmar International is the largest palm oil supplier in the world, benefiting the company directly in the form of zero dependence on third-party suppliers, market intelligence on price movements, and inventory management. Adani Wilmar also has a strong relationship with a large soybean crusher in Argentina, ensuring direct availability of crude soybean oil. Out of its 19 refineries, 10 are port-based to facilitate further processing of imported crude edible oil without incurring much transportation cost. Specialty fats, derived from palm oil and catering to the institutional business, are also manufactured at port-based refineries such as Kakinada, Mundra, Krishnapatnam, and Haldia. This provides logistic advantages to cater to all regions of the country. However, edible oil is also subject to vagaries of having to import either crude or refined palm oils from time to time, depending on the cost advantage provided by each, or the government's tweaking of the duty structure. For instance, to increase domestic supply, control price rise and reduce time to market of edible oils, the government, in December 2021 encouraged import of refined palm oil by slashing the basic customs duty on the same. Refined palm oil or palmolane was also allowed to be imported without requirement for permit until December 31, 2022. But the narrowing of the duty differential between crude and refined oil, as well as the higher export duties on crude oil by countries such as Indonesia, is making domestic refining unviable currently. Utilization of refining capacities of Adani Wilmar is at 48% in the half-year ended September 2021, and has been in the 50 to 60% range over the last 3 fiscals. Thus, edible oil importers need to be able to wade through policy uncertainties from time to time. International crude palm and soybean oil prices have shot up to $1,300 to $1,400 levels per metric ton now, compared with the $400 to $500 levels at the start of the pandemic. Given its brand visibility and pricing power, Adani Wilmar has been able to pass on the costs to customers. In the year ended March 2021, for instance, volumes grew year-on-year by just 4%, but revenues grew by 25%, indicating the price increase. Despite this, EBITDA margins contracted to 3.8% from 4.8% in the previous fiscal. EBITDA per metric ton also dropped marginally. For the half year ended September 2021, volumes grew by only 1%, but revenues by 54%. EBITDA margins stood at 3.5%, lower by 1 percentage point year-on-year, but EBITDA per metric ton grew by 18.7%. Lag or gaps in passing on price increases, down trading within the edible oil segment, and increase in other expenses, such as advertising, can also exert pressures on margins. Currently, at just 11% of revenues, the food and FMCG business is EBITDA neutral. The company currently makes soaps, hand wash and sanitizers under the Alife brand. Apart from ready-to-eat kitschdi under the Fortune brand, it is eyeing entry into dishwash, floor cleaner, noodles, pasta, a side of functional oils and fortified staples, which are higher margin segment. This is not new, given that other oil players like Marico have adopted a similar route, but an expansion into FMCG is easier said than done. For one, even as the company is striving to reduce costs by setting up integrated manufacturing facilities for oils and packaged foods, by backward or forward integration into various inputs for products for home care or personal care, and by using common distribution network, the presence of well-entrenched players, including MNCs, is a big challenge. While it is true that FMCG can bring in higher margins than edible oils, requirement of high advertising spends and already high penetration levels in many categories implies that market share, pricing power, and margin expansion is not a given. Even after 20 years and several acquisitions, ITC, a latecomer to the FMCG business, makes around 5 to 6% margins in this business. Agrotech Foods, which sells Sundrop oil and other ready-to-eat foods, also has only 6 to 8% margins. Marico does show 16 to 20% margins. Any re-rating for Adani Wilmar will depend on how the FMCG business pans out.